Good afternoon, everyone. Thank you for joining us for today's webinar. If you would go ahead and take the opportunity to retrieve the handouts or the resources we have in the handout section of the webinar, but greatly appreciated. I included in those handouts is a white paper of today's webinar. In addition, you'll find, as usual, some booklets and other resources for the webinar. We have about 1 minute until the top of the hour. I did want to explain to those that are new to Consolidated Credit's monthly webinar that this is not a interactive webinar. There are not there's no space given for questions and that sort of thing. However, upon completion of the webinar, should you have any questions, comments, or what have you, you will be provided with an email address whereby you can voice any opinions and questions and so forth. So with that being said, let's go ahead and get started. It is the top of the hour, and our webinar today is titled How to Invest Without Being Rich. You can profit without wealth and with little risk by investing in yourself. Usually we talk about saving, but today we're talking about investing. Let's start with what we won't be talking about. We're not here to convince you to buy a certain stock or even worse, start day trading. Instead, we want to talk about earning reliable returns on your investment while investing your money safely. That is what we want to discuss today. In all kinds of investing, risk tolerance is an important concept. Simply put, risk tolerance is how much of a financial loss you're willing to endure if it means making a financial gain later. There are three broad categories of risk tolerance, aggressive, moderate, and conservative. Most people start off conservative as they learn how investing works, and we fully endorse that idea. Otherwise, it's like going all in during a poker tournament when you've never played poker before. What's the difference? A stock gives you partial ownership in a company, while a bond is a loan from you to the government. So stocks can keep rising while a bond's return is determined when you buy it. Of course, those stocks can lose value as well. That makes them riskier, but potentially more profitable. Now, let's get on to the different ways to get started with investing. The first place you might want to look is where you work. Your employer might have benefits that can save you and save you big. One of the most popular ways to invest is a 401k, which helps you save for retirement. What's so special about a 401k? Many employers match a portion of your contribution to this retirement account. That's free money just for saving. Nearly 7 in 10 Americans have access to a 401k through their employer. All you need to do is ask your human resources department how to get started. You fill out some paperwork, choose a percent of your salary to set aside, and suddenly you're saving money. Even better, you don't notice it's gone because it comes off the top of each paycheck automatically. Ask your HR department about 401ks as soon as you can. According to government research, the average is 4.3%. That means for every dollar you sock away for later, you get 43 cents. Now, that doesn't sound like much, but when you consider a savings account is paying less than 1% in interest these days, that's suddenly a lot. Also, the IRS gives you some money too. It doesn't tax you on what you contribute. And since this is for your retirement, which is probably a long ways off, those savings will build up over time. A 401k isn't just a tax free way to save for retirement, and the employee match isn't the only way to make money. You also invest your savings inside the 401k. In other words, the money doesn't just sit there like a savings account. No, you get to choose different ways to invest your 401k from safer to riskier. Depending on your 401k, you can invest in different ways. For instance, you can invest in stocks, which are riskier, and bonds, which are safer. Historically, stocks can usually make you more money than bonds. The good thing about 401ks is that you don't buy individual stocks. You buy into a collection of stocks called a fund. So, a stock fund or a bond fund will have many stocks or bonds within it, which lowers your risk. You can still choose a fund that has a collection of riskier stocks, but you don't have to worry about choosing from hundreds of options. Again, depending on your 401k, you might have only a few options to consider. That's actually good if you're just learning how to invest. For example, you'll quickly learn that international stock funds can be riskier than United States stock funds. And you'll also learn that sometimes the reverse can be true. Rebalancing is a key investment concept you can learn with a 401k before doing it on your own later. Basically, if you're successful, your investments are going to make more money. For instance, if your portfolio has 80% stocks and 20% bonds, your stocks might outperform your bonds. Then suddenly you have more money in your 401k that are in stocks. So you want to shift some of it to bonds just to keep that 80-20 balance. Now, if your head is already starting to spin, you're beginning to understand how complicated investing can be. Fortunately, you can get free help. If your employer offers a 401k, they often don't start it up on their own. They work with big financial companies you've probably heard of, like Vanguard, Fidelity, Merrill. These 401k providers offer a range of educational services. They won't tell you what exactly to invest in, but they'll help explain the concepts. Some even offer online quizzes to help you determine your risk tolerance. And all of this is free. Another way you can invest through your workplace is called a health savings account or HSA. It does the same thing as a 401k and has similar tax benefits, except you set aside money for health care instead of retirement. The only requirement to set up an HSA let's say that again, HSA, is to have a high deductible health plan. One of the best things about an HSA is that they belong to the individual, so you won't lose access to them even if they switch. We could spend an entire webinar talking about these lucrative benefits, but we suggest that you contact your HR department. Okay, now let's start talking about investments outside of work. The good news is that you can learn investing with very small sums. We're talking sums as little as $100. The goal here isn't to make a lot of money, it's to learn how to make a lot of money. Investing is just like anything else. It takes some time to get good at it. So let's look at some safe and easy ways to start. The first rule of investing is simple. Don't invest money you don't have. That sounds obvious and maybe even silly, but you'd be surprised how many people have steep credit card balances but decide to invest in the stock market. The stock market will historically make you only half of what credit cards charge you on your balances. However, never invest in the stock market if you have credit card balances you haven't paid off. If you do have the cash, here are a few ways to get started with investing on your own. Your 401k is a retirement account you get through work. If you don't have access to one, or if you just want to save more for retirement, you can open an individual retirement account or IRA or IRA. They work a lot like a 401k, except it's all on your own without your workplace helping you. Still, you'll deal with all the same concepts we've been talking about, from risk tolerance to rebalancing. The easiest place to start, try your bank or your credit union. A mutual fund is a lot like the stock funds we talked about earlier. They're an investment that pools money from other investors like yourself, then uses that combined cash to buy stocks. Best of all, they're run by professionals who pick the individual stocks so you don't have to. Federal law makes this all very transparent. So if you don't like the returns you're making, you can cash out and buy into other mutual funds. Check out the long list of mutual funds at bankrate.com and US News. If you really want to make money, getting rid of your debt is actually the most lucrative thing you can do. It seems like it has nothing to do with investing, but it really has everything to do with it. If you invest $1,000 in the stock market, you can expect to earn between $7 and $8 at the end of the year. But if you have $1,000 in credit card debt, you can expect to pay around $15 in interest charges. Now, that's double what you would have earned in the market. So, obviously, the first step is paying off those credit cards. The big question then is, how do you get out of debt? You can call an expert for free, a certified credit counselor from a nonprofit credit counseling agency. They'll give you a free in debt analysis over the phone. Then they'll lay out all your options for getting debt free. By law, they must give you all the options that are good for you. These aren't stockbrokers who try to get you into stock funds that earn them high commissions and you low returns. So, how do you find a reputable credit counseling agency? There are three easy steps. First, scour their websites and see when the company was founded. The older, the better. Second, look up online reviews. Most should be glowing, and the ones that aren't should have a response from the agency that addresses the problem. Third, go to bbb.org and look up the agency. That's the website for the Better Business Bureau. And you're looking for a A plus, which is their highest rating. So that's it. Short and sweet. Actually, that's just the beginning if you think about it. If you use these tips and see good results, you're well on your way to grasping the complexities of investing and making money. Thank you all for attending this month's webinar. May the rest of your day be the best of your day. Thank you and take care.